Hello, everyone. Welcome to the next edition of our PwC Tax Bite podcast. Today, we will talk about the US elections and more specific, what this could mean from a tax perspective. I have the right experts with me for an interesting discussion on this topic. And first of all, I have with me Tom Patton. Tom is a US tax partner seconded to London, and he's working with various European businesses that look at the US market. Many of you may have been in contact with Tom already for questions on US taxation. Also, Evie Geerts is here with us today. Evie, a director in our global tax team, spent many years secondment in New York. So she has been on the terrain and knows better than anyone else here in our team what it means to be active in the US and what US taxation is about. And also we have Jean-Philippe van West with us. Jean-Philippe is an expert in European law, and he will bring us the European perspective to the topic. Interesting topic, lots to say about it. So I suggest we kick off. And perhaps my first question is for you, Tom. The US elections have been on the front page for months, also in Europe. And now that the dust is settling down a little bit, it might be good to start this discussion with a quick recap for our listeners on the outcome of the elections and what this could mean for the Biden administration in terms of options going forward.
Sure. Thanks, Peter. What we saw this time around in the election was it took until January for us to really understand what the makeup of Congress really was, and were the Democrats going to have control of the entire Congress. And so that was looking at the runoff elections in Georgia, which the Democrats took both seats on. And so in the Senate, that means it's a 50-50 split between the Democrats and the Republicans. With a Democratic-controlled White House, that means, in effect, that Democrats control the Senate as a result of the vice president having a tie-break vote. And they have a majority of about 10 seats in the House as well. So in principle, this means the Democrats can enact legislation without the need to have the Republicans on side. That being said, there are some limits to the ability to do that. So they'll have to work within budget constraints to get there. They won't be able to just pass legislation that is just entirely unfunded or without regard to what the budget outlook is. There's a specific procedure that they're going to have to follow. And perhaps more importantly, that majority or that control is there, but it does require, for instance, in the Senate, having all 50 Democrats on board. The majority of 10 in the House is also not massive, and they're going to have their eye on elections in 2022. So, notwithstanding this, this was, as you say, was in the paper for months. 2022 doesn't, in fact, seem that far away for yet another election. But the House will be fully up for re-election, and then 1/3 of the Senate will be up as well. So they're going to have that in mind in terms of how they will approach what they pass. And I think in part what that means is that speed will be important. They're going to need to look at doing things in 2021. And that's because sliding into 2022 is not a good outcome, because you're now talking about trying to get major legislation done in an election year, which always proves to be a bit more challenging. So first and foremost, I think they're going to look at COVID relief and incentives. We've already seen a number of things being proposed, both in terms of a budget as well as some detailed proposals. For now, they're focused more on what those reliefs look like as opposed to specific tax provisions, but we could expect to see some more activity later on in the year as it relates to tax.
Okay, thanks, Tom. So clearly there will be likely some room for changes in the tax system. So now I'm a little bit curious what these changes could be about. And Evie, may I ask you perhaps, in the run-up to the elections, I think that the Biden administration already made some proposals. If we look at those, can we learn something of the direction that the changes could go to?
Absolutely, Peter. I'll try to summarize them for you, and starting off with the easiest and probably the one most of you are aware of, and that is an increase of the rates from 21 today to potentially 28. That was at least a number that was floated throughout the campaign, and I'm sure Tom will share some thoughts on where we might end up in reality. Then another one that's quite important is a reduction of the guilty deduction to 25%, where it's 50 today. That will have an impact for many US multinationals, but also groups investing in the US. Linked to guilty, there is was also a proposal to apply it on a country by country basis, which then has a link to the Pillar 2 discussion at OECD level, but we'll touch upon that later. And then a change to the qualified business asset investment calculation that is part of the guilty setup. Another one is yet another minimum taxation in the US. They already have a couple, but this time on a global book tax income. And then from a European perspective, something that is at least probably more perceived in the same mindset as what the Trump administration was looking at. So a 10% offshoring penalty if you take activities outside of the US, and a 10% tax credit for new investments in manufacturing in the US. So those is as a short summary, Peter, of what we heard during the run-up of the elections from the Biden administration. But Tom, you already referred to it. They only have a small majority in the Senate, and also the House is not an overall win. So what do we think in reality we can expect in the coming years in terms of tax reform at the US level?
Well, Evie, I think, it's important to bear in mind, timing as well too, right? That if they need to get something done this year, they need to make sure everyone is on board, but they're gonna have limited time to really think deeply about what more complicated changes might actually mean, right? And I think they want to try and avoid something that requires a lot of explanation or that might trigger a lot of debate, and try and find the path of least resistance. So really, when I think you look at some of the things that were proposed during the campaign, many of them are, I think, a bit too complex for Congress to take on. Things like the country by country on guilty, and is I think a good example of being too complex in terms of where they might get to at the end of the day. And so I think, simply put, what I would expect to see is certainly an increase to the corporate rate. I suspect it's very unlikely we'd ever see a 28%. It's probably at most going to be something like 25, and may not even be that high. It would not surprise me at all if they reduced the guilty deduction, because it's sort of relatively explainable. It's almost just a budget impact in some respects of that, what does it mean to the government's take if the deduction was 25% instead of 50. I mean, it's important to bear in mind that if you change the guilty deduction, what also happens, absent some other change to the architecture of the rules, what also happens is that the foreign derived intangible income deduction goes down as well. So those two things go hand in hand, and you'd expect there, if we're going to reduce the deduction against guilty inclusions, that we might also see, or probably also would see, reductions to the foreign derived intangible income benefits, on the back of that as well. So again, I think it's really important to keep things simple. I would also put the minimum tax on book income as being in the complex box and very unlikely. And I think they're way more likely to say dial up the beat rate as a way to deal with the minimum tax regime, as opposed to just adopting yet another regime that everybody has to understand and consider the overall outcome on. I mean, we've already seen a number of I would say detailed proposals from individual persons in Congress, whether in the Senate or the House. I think mostly on the Senate side, but where a lot of those are coming from Republicans trying to limit a little bit where the Democrats might go on these things. And when you hear about those things, sometimes that's just simply someone standing on the floor of the Congress and introducing a bill, and that bill just may never go anywhere, may never even see a vote. So there'll be a lot of noise in the system as we get through it, but I really suspect at the end of the day, it's going to be that simpler approach.
Thanks, Tom. What you mentioned on dialing up the beat rate is an interesting one because indeed, from my perspective, looking at it, that's probably one of the easiest ways to increase the minimum tax. And it is also very relevant for all our European companies investing in the US because many of them are confronted with BEAT. So that's an interesting one to share. Maybe another one that many of them are confronted with is the track record in terms of ratifying double tax treaties. Recently, an Hungarian treaty was postponed, but do we have an idea, Tom, on whether we can expect the ratification of the treaties anytime soon, or what the holdup is there?
Yeah, we don't actually have a specific indication, although we do know it's on people's radar, if you will. The issue came up, for example, in the hearings for Treasury Secretary Yellen, and she mentioned that it was a priority to get some of those issues resolved. What had happened was, going back a few years, excuse me, there were some objections within the Senate itself on ratifying treaties that had information sharing provisions. It took quite a while, but eventually that concern was overruled, and that effectively unlocked the Senate's ability to start ratifying treaties. And so, in the summer of 2019, some of those treaties that had been held up for a while, finally were ratified. Spain is a very good example of one. The Hungarian treaty had been renegotiated for quite a few years ago, and that did not get ratified in the end because of a concern around the non-discrimination article in that treaty and applying in such a manner as to eliminate BEAT for payments made to qualifying Hungarian residents. So that put ratification on hold while they tried to figure out what to do on that. And it's a rather technical point, but the difference between that and, for example, the Spanish treaty was a protocol, which is kind of an amendment to the existing treaty, if you will, and the treaty with Hungary was a brand new one, and there was a concern that because it was an entirely new treaty ratified after the enactment of BEAT, that treaty would actually overrule the BEAT provision. So that's the sticking point on that. I think there are a number of higher priority issues that Treasury likely will deal with before we get to fixing or figuring out what they're going to do on that treaty issue. So we don't actually have an indication of timing yet, but I would be surprised if it was this year. I suspect it's really going to be something that'll slide on into next year.
Okay, thanks, Tom and Evie, for sharing your insights in what we can possibly expect in the US. I think it's time now to take a look at the other side of the ocean, let's say, and wonder how the relationship with the European Union can evolve. And then, Jean-Philippe, I come to you, of course. I think the European Union issued a kind of transatlantic agenda for global change in December. What is your takeaway from that document, Jean-Philippe?
Thank you, Pierre. So let me try to summarize in a few words the most relevant aspects of the proposal for a new transatlantic agenda put forward by the European Commission beginning of December. Although the document does not explicitly mention this, it's not a secret that the relationship between Europe and the US was a bit troubled under the Trump administration. The European Commission wants to change the dynamics and counts on the Biden administration for a better collaboration. From the perspective of the European Commission, there are many commonalities between the political agenda of the US and the agenda of Europe. And therefore, the European Commission wishes to work together with the US to address some of the most urgent global challenges. So what are these shared interests according to the European Commission? Well, in this regard, the transatlantic agenda contains 4 building blocks. First, and not surprisingly, of course, the recovery from the COVID crisis. Second, working together on climate change. The third building block is protecting our liberal democracies as compared to more authoritarian regimes and closed economies. And the fourth and last building block is working together on trade, digital, and technology. So these are the 4 cornerstones of the transatlantic agenda proposed by the European Commission. But maybe more relevant, what does the agenda say about tax? And here I would like to emphasize 2 points. First, with respect to the second building block on climate change, the proposal mentions the EU and the US should work closely together on emissions trading, carbon pricing, and taxation. And second, with respect to the taxation of the digital economy, the Commission document states that the US and the EU should strongly commit to reach a global solution within the context of the OECD.
Thanks, Jean-Philippe, and thanks for bringing that point up on the pillars, because it's, I think, for myself, for the listeners, a very important topic. It was also touched on, I think, in the very beginning of this podcast, and we had the previous podcast already on the direction of travel for Pillar 1 and Pillar 2. Evie, can you recap for me and the listeners where we stand today with the pillars?
Absolutely, Peter. As you might remember, the OECD proposal contains 2 important elements. Pillar 1, basically, in very short, a reallocation of taxing rights, and then a global minimum tax via Pillar 2. Everybody following the debate that's been going on for months will remember that the US had some strong objections against Pillar 1. And also on Pillar 2, there was quite a bit back and forth on what would happen with guilty under Pillar 2, because guilty, for the ones who have a view on the mechanics behind Pillar 2, there is an income inclusion rule there, which definitely is partly based on the US guilty regime. And in order for Pillar 2 to pass, the US has strongly pushed for a grandfathering of the guilty regime. Now, in the end, where we ended up under the last blueprint of Pillar 2 is that there is some kind of coexistence foreseen between the income inclusion rule or the entire setup of the global minimum tax rule and guilty. Meaning that as long as the guilty regime wouldn't change significantly under the Biden administration, it would be able to coexist with the rules under the globe taxation of Pillar 2. That being said, there's definitely no final answer yet on what the US view is there. So maybe, Tom, do you expect a change in mindset from the US on Pillar 1, Pillar 2? Do you think there will be more buy-in? What's your view there?
Well, I think that, there's more broadly, there's clearly a change in approach of the administration in terms of being at the table, and we saw last week President Biden say diplomacy is back, and the U.S. has rejoined the Paris Accord, and so there's I think how the government will approach some of these discussions is clearly going to be very different. But I think it's important to remember that many of the underlying policies, particularly as it relates to BEPS and things like Pillar 1 and Pillar 2, those policies date back to the Obama administration. So it's a question that's come up quite a lot of, now we have the Biden administration in place. Does that mean all of this stuff will kind of easily get unlocked? And it's hard to see that. I think there's still quite a bit of challenges. There are still quite a bit of challenges to work through in getting something done. And you take something like the grandfathering of guilty and treating it as effectively a qualifying income inclusion rule. What that's really getting at is, the situation where you have U.S. multinationals having intermediate holding companies, and the structure of the OECD's approach to that is to deem the guilty regime to be a qualifying income inclusion rule, such that it turns off that same regime, that Pillar 2 issue at an intermediate holdco level. If it's the other way around, where we have a non-U.S. parent and the U.S. as an intermediate holdco, it's very hard to see right now what is the path to turn off guilty where the parent has a qualifying income regime. And that would require some major statutory change. It's not impossible, but it feels extremely challenging. So, I mean, we have seen there was one proposal. One of the things I was alluding to earlier, in terms of individual senators making a variety of proposals, is one of them proposed that whatever change to the guilty deduction we get ought to be forced to stay in line with the OECD minimum tax rules, as a kind of approach to ensuring that it remains a qualifying regime. But I think there's a whole lot that needs to get done as it relates to guilty and Pillar 2. One of the other issues with that, for example, is that the OECD report said, well, it would be appropriate to turn off BEAT if the recipient was subject to, a Pillar 2 regime, or if Pillar 2 was relevant, I should say, to the receipt of that payment. Again, that feels very challenging. And then finally, I guess just back to Pillar 1, we know that the U.S. administration or U.S. tax policy has been pretty resistant to dealing with digital tax issues in different ways than other other businesses and other markets, and that's that will continue. So there's still going to be challenges on that as well. So unfortunately, I don't really have a clear outlook on that, other than to use the word challenging quite a bit. But I think it's important to understand that diplomacy is not the same thing as agreeing on some of the underlying tax policies, of course.
Okay, thanks, Tom, for sharing that. I think we come at the end of our podcast. This is all we had time for today. Very interesting to see that there will be room for changes. What I take from the podcast is that it needs still to be seen which room that the Biden administration will take for making changes to tax laws as opposed to other changes. But there's definitely going to be some changes ahead. So we'll definitely come back to the listeners in a new podcast if there's more specific changes that we see. For now, I want to thank the speakers. So Tom, Evie, Jean-Philippe, thank you very much for joining us. And of course, I want to thank the listeners for tuning in our podcast series. Thank you.